Hey everyone, welcome back to English Podcast for Listening and Speaking. Alec here at the mic with you.
And hi, wonderful people. It's Emily. Today's topic sounds serious, but I'm honestly excited and a little nerdy.
Yeah, because we're talking about accounting and finance, the stuff that quietly decides whether companies live or collapse.
Every company, even the cute little family shop, must keep financial records and report them to the government, right?
Exactly. If they don't, the penalties can be huge, sometimes largely catastrophic for the business and its employees.
I always picture a stressed manager thinking, we sold a lot, but can we actually pay anyone this month?
That stress is usually a numbers problem, not pure drama. Accounting partially predicts disaster before it becomes headline news.
So, our episode today is about accounting and finance money, rules, and real risks. Big title, big feelings.
And we're connecting it to an article you read for homework about automation, cash flow, and tax law changes.
Before we go deeper, quick hello to any new listeners joining us for the first time today.
This show helps you practice real English through real conversations, not stiff textbook dialogues that nobody actually uses.
And if that sounds useful, please pause for a second, hit like, subscribe, and share this with one colleague.
Seriously, your likes and comments mostly tell YouTube, hey, this is helpful, and then more learners can find us.
Okay, let's talk about that article. Alec, what was your first reaction when you finished reading it?
I'd say it was largely realistic, but partially too optimistic about how smoothly companies adopt automation and AI.
Haha, same here. I felt impressed and slightly scared. Automation sounded powerful, but humans still seemed very vulnerable.
The article argued that AI will handle repetitive bookkeeping and reporting, freeing accountants for more strategic thinking.
Which sounds beautiful in theory, but I'm partially worried some companies will just cut jobs instead of responsibilities.
Good point. I'd argue the article was mostly right about tools, but less honest about emotional impact on workers.
Also, the section on tax law changes felt very familiar. Constantly changing rules, confused managers, nervous finance teams everywhere.
Yeah, the article said businesses must adapt quickly or risk penalties and audits, which is arguably completely true.
Listeners, how did you feel reading it? Were you mostly hopeful about AI or mostly anxious about your job?
And which part hit you hardest emotionally? Automation, cash flow problems, or ever-changing tax regulations and compliance requirements?
Tell us in the comments later. We genuinely read them, and they partly guide future episodes and examples we choose.
Let's zoom back and ask the big question. Why does accounting matter so much that governments obsess over it?
First, because money isn't just numbers. It's salaries, rent, suppliers, investors, survival. Accounting largely keeps that whole system honest.
Second, because shareholders, banks, and even employees need transparent information to decide whether a company is healthy or collapsing.
And third, because governments need accurate numbers to collect tax and keep the wider economic machine running somewhat smoothly.
If a company lies or reports late, the consequences can be partially financial and partially criminal, depending on the situation.
That sounds dramatic, but it's real. People lose jobs, pensions disappear, communities suffer when accounting goes badly wrong.
Think about big scandals from the past. They were largely accounting failures, hidden debts, fake profits, creative numbers on reports.
So, if you ever thought accounting was just boring spreadsheets, today we're arguing it's secretly very dramatic.
Exactly. Accounting is like the heart monitor of a company. When the lines go weird, everyone should pay attention.
Let's connect to our listening skill focus. Hearing qualifications, those small words that limit or soften statements.
When the article said automation is mostly positive, that mostly should immediately attract your attention as a listener.
It means not always positive, not for everyone, not in every situation. Hidden limits live inside that tiny word.
Same with tax law changes are largely necessary. Largely suggests there are partially painful, maybe unfair parts as well.
So if your boss says, our finances are mostly fine, your ears should quietly ask, okay, what's not fine?
Exactly. Those qualifiers mostly, partially, largely, arguably are like small warning lights on the dashboard of any conversation.
In this episode, we'll use them a lot so your ears get used to noticing them automatically during business discussions.
And we'll also dig into concrete terms like bookkeeping, payroll, cash flow, in the red, in the black, insolvency, bankruptcy.
But don't worry, we'll explain them with real feelings, not just cold dictionary definitions that make your brain sleepy.
Let's check in with you. When you hear accounting department, what's your honest emotional reaction? Boredom, respect, fear, confusion?
Do you picture heroes saving the company or people hiding in a back room with coffee and spreadsheets forever?
From my perspective, accounting is mostly invisible when it works well and extremely visible when it fails dramatically.
Yeah, nobody says thank you, bookkeeping team during good years, but everyone screams when numbers go wrong once.
The article mentioned cash flow as a major challenge. We'll unpack that deeply in the next section because it's vital.
It also highlighted AI tools that can predict cash flow and flag risks earlier than humans, sometimes notice them.
But again, that's partially true. AI is fast with patterns, but humans still understand context, politics, and emotions.
I'm curious, listeners. Do you trust AI with your company's money more, less, or about the same as humans?
And would you feel comfortable if your salary depended on an algorithm's decision about payroll timing and cash availability?
If that thought makes your stomach tighten a little, you're not alone. Money touches our deepest security and fear.
So during this episode, we want you to learn vocabulary, grammar patterns, and also feel the real-world weight behind them.
We'll talk about regulation, penalties, creative accounting, and why "in the red" is more than just a cute idiom.
And we'll keep asking questions so you can connect this to your own company, your country, and maybe your career.
Before we move on, quick reminder again, if you find this helpful, please like, share, and drop a short comment.
You could simply write, accounting is mostly, and finish the sentence honestly from your experience or imagination.
That tiny action helps other learners because it pushes this episode slightly higher in YouTube's recommendation system.
All right. In the next section, we'll answer what accounting and finance actually do all day besides drinking coffee.
And we'll invite a young accountant to join the conversation so you hear how this feels from the inside.
All right, let's get practical now and talk about what accounting and finance actually do daily.
Because honestly, a lot of people just imagine spreadsheets, headaches, and mysterious reports nobody really understands.
At the core, the accounting department records everything that happens with money, then turns it into readable information.
And the finance side mostly uses that information to plan, decide, and protect the company's future, right?
Exactly. Accounting answers, what happened with our money? Finance answers, what should we do with money next?
Let's start with a beautiful, underrated word, bookkeeping. I weirdly love that word. It sounds careful and rhythmic.
Bookkeeping is simply recording every transaction accurately. Sales, purchases, salaries, rent, tax, interest, everything involving money.
So when a company buys laptops, pays electricity, or receives customer payments, bookkeeping catches those moments in the system.
From my perspective, bookkeeping is largely about discipline and consistency, not wild genius or heroic creativity.
Yeah, if bookkeeping is sloppy, everything else becomes unstable. Reports, taxes, decisions, they're all partially wrong then.
Imagine a restaurant. Bookkeeping tracks ingredients purchased, salaries, customer bills, maybe delivery app commissions and card fees.
Without that, the owner might emotionally feel busy, but never know if they're actually profitable or slowly dying.
Next keyword, payroll. Payroll is the money a company pays employees, usually every month or every 2 weeks.
Payroll sounds technical, but emotionally, it's heavy. If payroll fails, people can't pay rent or feed families.
Exactly. Payroll must be accurate and on time. Employees mostly forgive many things, but not missing salary day.
So accounting teams handle payroll calculations. Hours, overtime, bonuses, taxes, social insurance, all the boring, terrifying stuff.
Finance also estimates future payroll costs, asking, can we afford new staff? Are salaries sustainable long-term?
Listener question time. Does payroll in your country usually feel reliable, or do people worry about late payments?
Tell us in the comments if you've ever experienced a delayed salary and how that felt emotionally and practically.
Now, what financial information do companies actually need to report besides, "We're doing fine, please trust us"?
They must report revenue, expenses, profits, assets, debts, equity, and often detailed breakdowns for regulators and stakeholders.
Stakeholders include shareholders, banks, employees, sometimes even the community, right? Many people quietly depend on those numbers.
Yes, and governments need information for tax. They require compliance with rules about what must be disclosed and when.
I'd argue accounting is partly about transparency. You're saying, this is our financial story, checked and structured.
And if that story is unclear, investors might hesitate, banks might refuse loans, regulators might become suspicious quickly.
Let's bring in someone who lives this every day. Carlos, thanks for joining us from the accounting battlefield.
Thanks for inviting me. Honestly, my days are mostly numbers, emails, and occasional mild panic around deadlines.
Haha, relatable. Could you walk listeners through a typical day for you in the accounting department?
Sure. I start by checking yesterday's transactions, updating bookkeeping records, and matching invoices against bank movements carefully.
So you're constantly asking, did this payment really happen? Does this invoice truly match this bank line?
Exactly. If something doesn't match, we investigate. Maybe a supplier overcharged or a customer paid the wrong reference.
And payroll? How involved are you with payroll tasks, and how stressful does that part usually feel?
Our team prepares payroll monthly. We calculate salaries, taxes, benefits. Emotionally, it's the part we double-check obsessively.
Because if you make a mistake, people feel angry, scared, betrayed, right? It's not just a number there.
Yes. One wrong digit can mean someone receives less money than promised. That's financially and emotionally serious for them.
From your perspective, is the accounting department mostly seen as supportive heroes or annoying rule enforcers inside the company?
Honestly, partially both. Some managers appreciate our warnings. Others feel we're blocking their fun spending ideas constantly.
Haha, I can imagine marketing wanting new campaigns while accounting quietly whispers, our cash balance says no.
Speaking of spending, let's talk about where company money actually goes. What are typical big expense categories, Carlos?
Usually payroll, rent or mortgage, raw materials, technology, marketing, interest on loans, and of course taxes eventually.
So, when we imagine companies, we should see rivers of money flowing out, not just magical piles coming in.
Exactly. That's why good bookkeeping and reporting matter. Without them, managers underestimate costs and overestimate profits dangerously.
I've seen managers emotionally convinced a project was great, but the numbers showed it was mostly burning cash.
That must feel awkward. You're partially destroying someone's dream, but also protecting the company from bigger disaster.
Yes, those conversations are tense. We try to use qualifiers. This was partly successful, but financially problematic overall.
That's a great listening example. Partly successful means not total failure, not total victory. Something complicated between.
Listeners, would you rather hear, this project failed, or this project was partially effective but not sustainable?
That second sentence hurts less and teaches more, right? It invites analysis, not just shame and blame.
Carlos, what do you wish non-finance colleagues understood better about accounting and finance departments?
I wish they understood we're not trying to kill ideas. We're trying to make them financially realistic and sustainable.
Nicely said. Accounting isn't anti-dream. It's the part that asks, can this dream survive contact with reality?
I love that. Dreams plus numbers. Without numbers, the dream might quietly drag the company toward insolvency eventually.
Quick reminder. Insolvency means you can't pay debts on time. We'll dive deeper into that in the next section.
Listener question. In your experience, is accounting mainly treated as a strategic partner or mostly as boring administration?
Comment with, in my company, accounting is mainly and completed honestly, even if it's not very flattering.
Carlos, before we let you go, how do automation and AI already affect your bookkeeping and reporting tasks?
Some repetitive work is automated now. Software matches transactions faster, but humans still handle exceptions and judgment decisions.
So automation is largely helpful, but still partially dependent on human checking, especially for weird or unusual cases.
And emotionally, do you feel mostly threatened or mostly supported by these tools entering your daily routine?
Honestly, mostly supported. I'm partially worried about the future, but I enjoy spending more time on analysis.
That's encouraging. Thanks a lot, Carlos, for bringing real-life detail into this conversation about roles and responsibilities.
Yes, thank you. Your mild panic around deadlines made this feel very human, not just theoretical and abstract.
So, to summarize this section, accounting records reality, finance plans action, and and both departments protect the company consistently.
They handle bookkeeping, payroll, reporting, and endless questions about whether the business is sinking or staying afloat.
In our next section, we'll zoom in on cash flow, being in the red, and the scary word insolvency.
Stay with us, because understanding cash flow could partly save your company or career from some nasty surprises.
So, we've met bookkeeping and payroll. Now let's talk about the thing that keeps managers awake at night.
Cash flow. Just hearing that phrase makes me imagine nervous glances at bank accounts and calendars, honestly.
Cash flow is simply the movement of cash into and out of a company. Inflows versus outflows over time.
Inflows include customer payments, investment money, maybe grants. Outflows include salaries, rent, suppliers, interest, tax, everything painful.
I like to compare cash flow to breathing. Profit is like fitness level, but cash flow is oxygen itself.
You can be technically fit on paper, but if you suddenly can't breathe, nothing else matters emotionally or physically.
Similarly, a company can show profit on its financial statements but still struggle to pay bills on time.
That sounds crazy at first, but it's mostly about timing. Money arrives late, but obligations arrive exactly on schedule.
Exactly. Sales today don't mean cash today. Customers often pay 30, 60, even 90 days after receiving an invoice.
Meanwhile, staff still expect payroll, landlords expect rent, and suppliers definitely expect payment without long philosophical discussions.
When outgoing payments are bigger or earlier than incoming cash, the company's bank account can slip into negative.
That's when we say the company is in the red. And emotionally, that phrase feels pretty scary.
In the red literally refers to negative balances, often written in red ink in old accounting books.
Being in the red means the company is losing money or doesn't have enough cash to cover obligations.
Short periods in the red can be manageable if there's a plan and strong future cash inflows coming soon.
But staying in the red for months is largely dangerous. Creditors become nervous, employees become anxious, banks stop smiling.
The opposite phrase is in the black, which means the company's bank balance is positive and operations are profitable.
I love that image. Being in the black feels like breathing easily after climbing a long, exhausting financial mountain.
Companies aim to be in the black consistently, but real life is messy. Some months are partly red, partly black.
Listeners, have you ever worked for a company where payday felt uncertain, like everyone secretly hoped the money arrived?
If yes, you've experienced the emotional side of cash flow problems, even without reading any financial statements whatsoever.
You might not have seen the numbers, but your body probably felt the tension. Tight stomach, nervous jokes, delayed plans.
Now, let's talk about insolvency. Insolvency is when a person or company cannot pay their debts when they're due.
So, insolvency is like a warning stage. You're not officially bankrupt yet, but you're financially drowning, basically.
Exactly. Insolvent companies might try to negotiate with creditors, change payment schedules, or restructure their operations to survive.
Bankruptcy is different. It's a formal legal process where debts are recognized as unpayable and assets are used systematically.
You can think of bankruptcy as the legal funeral of a company's current form, even if parts continue later.
Wow, that's dark but accurate. And emotionally, bankruptcy can be devastating for employees, owners, and local communities.
So, we should be careful with our language. A company can be temporarily in the red without being truly insolvent.
Right. One bad month doesn't equal doom, but long-term cash flow problems can largely push a company toward insolvency.
Here's a second conditional example to help you think about it. If a business stayed in the red for months, creditors would probably lose patience.
And if creditors lost patience, they might demand faster payment, cut credit lines, or even take legal action quickly.
Another one. If cash flow were always stable and predictable, managers would feel much less anxious and stressed.
Unfortunately, in reality, cash flow is partially predictable and partially chaotic, especially for small or fast-growing businesses.
Let's bring Carlos back for a minute, because he's seen this from the inside of real companies.
Carlos, have you worked with companies that looked successful externally but secretly faced cash flow nightmares?
Definitely. One client had strong sales growth, but customers paid late while costs increased. They were often in the red.
Interesting. So their profit reports looked fine, but their bank account looked mostly unhealthy and very fragile.
Exactly. They were technically profitable, but practically struggling to pay salaries and suppliers on time regularly.
That must have been emotionally exhausting. Did staff know, or was the tension mostly hidden behind polite emails?
Some staff knew. You can't fully hide delayed payments. Whispers start, and trust slowly erodes inside the company.
From your experience, what's the main mistake managers make when dealing with cash flow issues?
Many focus on revenue only. They ignore timing of payments, and they underestimate how fast outflows hit them.
So, they celebrate big contracts while the bank balance is quietly screaming, "I'm empty, please help me now."
That's why understanding cash flow is arguably more important than just staring at profit figures once a year.
Yes. I'd argue cash flow statements should be reviewed regularly, not treated as a boring formality for auditors.
Listener, question time. Does your company talk openly about cash flow, or is it mostly a secret topic for finance?
And how would you feel if your manager said, "We're profitable, but cash flow is partially unstable right now"?
That sentence is scary, but honest. It tells you the company is walking a narrow, slightly dangerous financial path.
Earlier we mentioned insolvency. Carlos, have you seen companies move from healthy to insolvent faster than expected?
Yes. Sometimes it only takes a few bad months, a lost client, or a delayed major payment to flip everything.
That sounds like standing on thin ice, thinking it's solid, until suddenly it cracks under your feet.
Exactly. If a company ignores warning signs, insolvency can sneak up quietly, then appear suddenly as an emergency.
That's why I always push managers to take early red flags seriously, not dismiss them as temporary annoyances.
Listeners, imagine this sentence. If we had monitored cash flow earlier, we might have avoided insolvency entirely.
That's a painful second conditional, but it happens. Many companies look back and realize the signs were mostly obvious.
So, what's the takeaway for you as a learner, even if you're not an accountant or finance specialist?
First, learn these phrases. Cash flow, in the red, in the black, insolvent, bankruptcy. They appear everywhere in business news.
Second, listen carefully when managers or news reports use qualifiers like mostly stable, partially recovered, or largely healthy.
Those tiny words show that underneath positive language, there might still be serious weaknesses or unresolved risks.
Third, realize numbers describe human stories. Salaries paid, suppliers respected, communities supported, or sometimes jobs lost.
Exactly. When you hear bankruptcy, don't just think legal process. Think emotional shockwaves across families and neighborhoods.
In the next section, we'll move to tax, compliance, and the sometimes dangerous idea of creative accounting.
Stay with us, because those topics show how numbers can be used responsibly or pushed into very risky territory. All right, time to walk into everyone's favorite emotional topic in business: tax, rules, and getting into trouble.
Haha, yes. The part where people suddenly look nervous and pretend they understand every form their accountant sends?
Every company pays some combination of taxes: corporate income tax, payroll taxes, sales tax, maybe property or local taxes.
But the exact mix varies a lot by country. Some systems are mostly simple, others feel like financial maze puzzles.
From my perspective, taxes are largely necessary for society, but the process can be painfully complicated for businesses.
And emotionally, many owners feel they're paying too much, especially when cash flow is already tight or unstable.
Listener question: in your country, do people complain businesses pay too much tax, too little, or roughly the right amount?
Tell us in the comments. You can start with, "In my country, companies mostly pay tax on," and continue.
Now let's bring in an expert voice. Mia, thanks for joining us again as our favorite slightly overwhelmed tax consultant.
Thanks for having me. Honestly, my days are mostly forms, emails, and clients panicking about deadlines and penalties.
That sounds intense already. Could you explain, in simple terms, what compliance means in the tax world?
Compliance basically means following the rules, filing reports on time, paying the correct amount, keeping proper financial documentation.
And when companies ignore compliance or misunderstand it, what kind of penalties are we talking about realistically?
It depends. Sometimes it's just fines and interest. In worse cases, audits, legal action, even criminal charges for serious fraud.
So, late reporting or inaccurate reporting isn't just embarrassing, it can be financially and emotionally catastrophic for businesses.
Exactly. Governments view late or false reporting as a serious threat to fairness and the whole tax system's stability.
I'd argue most companies want to be compliant, but they're partially confused and overwhelmed by changing regulations every year.
That brings us nicely to another question. Why do tax laws change so often, and how does that impact businesses?
Governments adjust tax laws to respond to economic conditions, political promises, loopholes, and sometimes public anger about inequality.
So, when a loophole becomes famous in the news, politicians feel pressure to close it, sometimes quite aggressively.
Exactly. For businesses, frequent changes mean constant learning, system updates, and sometimes expensive advice from tax professionals.
Emotionally, that must feel like walking on shifting sand. You think you understand the rules, then they partly change again.
How can companies anticipate these changes, Mia, instead of always reacting at the last minute with fear and confusion?
They follow news, join industry associations, talk with advisors regularly, and build conservative assumptions into their financial planning.
Conservative, meaning they plan safely, not politically conservative. They avoid counting on generous tax breaks that might disappear.
Yes. A conservative approach means assuming less favorable conditions, so surprises are mostly positive, not disastrous.
Now, let's step into the slightly darker, very interesting area, minimizing tax and that mysterious phrase, creative accounting.
First, minimizing tax can be perfectly legal. Companies use legitimate deductions, credits, and structures to reduce their tax bill.
That's called tax planning. It's largely legal, as long as the goal is compliance within the spirit of the law.
But sometimes companies go further, using aggressive strategies that push close to the edge of what's acceptable.
Aggressive tax planning might technically follow the rules, but it exploits loopholes that lawmakers arguably never intended.
Exactly. That's where audits often focus. Authorities ask whether arrangements are mostly artificial and designed purely to avoid tax.
And then we have creative accounting, which sounds fun and imaginative, but feels slightly dangerous to my heart.
Creative accounting means presenting numbers in ways that make the company look healthier without technically lying immediately.
For example, delaying recognition of expenses or valuing assets optimistically to make profits appear higher than reality.
So, they're not outright falsifying numbers, but they're stretching the rules and the truth, emotionally and ethically.
I'd argue creative accounting is partially clever and partially irresponsible, because it hides risk from stakeholders who rely on transparency.
And if it goes too far, it can effectively become fraud, not just creativity. Then the penalties can be severe.
Listeners, have you heard of high-profile scandals where creative accounting led to bankruptcy and massive public anger?
Many famous collapses started with small adjustments that slowly became a pattern of misleading financial reporting.
That's why good auditors are important. An audit is an independent examination of financial statements for accuracy and fairness.
Auditors check whether numbers are mostly reasonable, not obviously manipulated to impress banks, investors, or regulators.
They test samples, question management, and look for signs of aggressive or suspicious accounting choices in key areas.
Some companies prefer conservative accounting, showing lower profits now to avoid future disappointment and potential accusations.
Others choose aggressive accounting, pushing profits higher to impress investors, even if future periods will suffer badly.
From an ethical perspective, which approach do you personally respect more, Mia, conservative or aggressive accounting?
I respect conservative accounting more. It's largely more sustainable and less likely to damage trust in the long term.
That makes sense. Trust, once broken, is extremely hard to rebuild, especially when money and people's lives are involved.
Listener question. In your opinion, is creative accounting mostly clever problem-solving or mostly dangerous manipulation?
Write one sentence starting with, I'd argue that creative accounting is largely, and finish with your honest viewpoint.
Let's also touch consequences again. What happens if a company reports late or inaccurately, beyond just paying a small fine?
Besides financial penalties, they might face deeper audits, damaged reputation, lost investor confidence, maybe tighter credit conditions.
So, even if the company survives financially, the relationship with stakeholders can be permanently weakened.
And that damage can be more expensive than the original tax bill, especially if key partners lose trust completely.
Exactly. I often tell clients, Being mostly transparent is cheaper than explaining creative decisions during an angry audit.
That's a powerful sentence. You're basically saying honesty is partially a financial strategy, not just a moral one.
Let's build a second conditional example. If the company had reported honestly from the beginning, the penalties would be smaller.
Or, if management had chosen conservative accounting, investors might feel more confident during difficult economic periods.
These sentences show how choices today affect future risk. Accounting is not just history, it's quietly shaping tomorrow.
That's why I encourage clients to think long-term. Short-term profit illusions are mostly dangerous illusions, not true success.
Before you go, Mia, what's one thing you want learners to remember about tax and compliance?
I'd say, tax laws are complex, but ignoring them is largely more expensive than learning and following them.
Well said. Thanks again, Mia, for bringing real-world tension and wisdom into this conversation.
Yes, thank you. I feel partially calmer and partially more scared, which probably means this discussion was honest.
So, in this section, we saw tax, compliance, penalties, audits, and the temptation of creative accounting and loopholes.
We also heard how qualifiers like largely, mostly, and partially show where something is legal but perhaps ethically risky.
In the next section, we'll look at automation and AI, and whether accountants should feel excited or threatened.
Stay with us, because the future of accounting is not purely robotic, but it's definitely changing in big ways.
First, we talked about rules and risk. Now let's talk about robots trying to join the department.
Haha, yes, the famous question. Will automation and AI mostly help accountants or quietly replace them completely one day?
The article claimed automation will handle repetitive tasks like basic bookkeeping, data entry, and simple report generation reliably.
That sounds partly amazing. Fewer boring tasks, more time for strategic thinking and human conversations, in theory at least.
It said AI can scan transactions, match invoices, flag suspicious items, and predict cash flow trends faster than humans.
I'm honestly impressed, but also slightly anxious. Money plus machines feels powerful and a bit scary together.
Let's use some qualifiers. AI is largely effective with repetitive, predictable tasks, but partially blind to context and nuance.
For example, a human might sense an emotional reason for late payment, while AI just sees a red overdue number.
Exactly. Automation doesn't feel panic, shame, or responsibility when payroll is late. Humans feel all of that intensely.
Listener question. Are you mostly excited or mostly worried when you hear about AI entering accounting and finance?
Comment with, I'm mostly hopeful because, or I'm partially worried because, and finish the sentence honestly.
Let's bring Carlos back, because he's actually working with some automated tools already, right in the accounting trenches.
Yes, our company recently introduced software that automatically reads invoices and suggests bookkeeping entries for each transaction.
So before automation, how did you handle those invoices, and how long did the process usually take roughly?
Previously, we typed everything manually. It was accurate but slow, and honestly pretty boring after a few hours.
And now with automation, what has changed emotionally and practically in your daily work routine?
The software handles standard invoices quickly. I mostly check exceptions, weird cases, and higher-risk items needing judgment.
So your job became slightly more analytical and slightly less mechanical, at least for now, which sounds positive.
Yes, I feel more like a problem solver than a typing machine. That part genuinely makes me happier.
But are you at least partially worried about the long-term impact on accounting jobs in general?
A little. I think routine roles might shrink, but analytical, communication-heavy roles will probably grow gradually.
That's a common view. AI removes some tasks, but it also creates new tasks humans are still better at.
For example, explaining numbers to non-finance managers, or discussing sensitive topics like insolvency or potential bankruptcy with stakeholders.
Exactly. Those conversations require empathy, nuance, and sometimes courage, which AI currently can't provide convincingly.
Let's build a second conditional example around this. If AI handled all data entry, what could human accountants focus on?
They could spend more time on advising managers, analyzing trends, and challenging unrealistic budgets or risky decisions.
So, that sentence is the kind you use when imagining a different future, not describing current reality.
Another one. If companies relied only on AI, They might miss subtle fraud patterns or political conflicts inside departments.
That shows a limit. AI is powerful, but not magically all-knowing, especially around human behavior and office politics.
Let's compare. AI is faster and more consistent with repetitive tasks. Humans are more flexible and more ethically responsible.
Also, humans can feel guilt, which is uncomfortable but useful. It stops many people from crossing dangerous lines.
I'd argue the best future is mostly collaboration. AI handles routine work. Humans handle judgment, communication, and ethics.
But that future demands new skills. Accountants need communication skills, critical thinking, maybe even soft leadership skills.
Listener, do you see yourself more as a data entry person or more as a finance advisor long-term?
If you want to survive automation, you might largely need to shift toward interpretation, not just recording information.
Carlos, have you noticed expectations changing around your role since automation arrived in your department?
Yes. My manager now asks for more commentary, not just numbers. I write explanations for reports more frequently.
That's interesting. So language skills, including business English, are partially becoming core skills, not optional extras anymore.
Exactly. You can't just say, here's the report. You must say, here's what this report actually means.
And sometimes, here's why being in the red this month isn't catastrophic, but still needs careful attention.
That's a great qualified sentence. Not catastrophic, but still serious. It teaches managers how worried they should feel.
Let's talk feelings more. What emotions do you see among colleagues when new accounting software or AI tools appear?
Mixed. Some feel mostly excited about efficiency, others feel deeply threatened, afraid their jobs might disappear eventually.
I get that. Change fatigue is real. People are already stressed. Then another system appears demanding new training.
If companies introduced automation with better communication, employees might feel less suspicious and more included in decisions.
Yeah, saying, this tool will mostly support you, feels different from, this tool will replace you. Big difference.
Another second conditional. If managers involved accounting staff early in tech decisions, adoption would probably go much smoother.
That's the kind of sentence you use to suggest smarter leadership behavior, not to attack anyone personally.
We should also compare small and large companies here. Big companies are usually more automated already, right?
Yes. Large firms are more likely to use advanced systems. Small businesses are mostly still semi-manual, semi-digital.
That means automation might hit them at different speeds, but the long-term direction is largely the same everywhere.
Listener question. In your workplace, are you using mostly manual spreadsheets, cloud accounting tools, or more advanced AI systems?
Share your situation. That context helps other learners compare experiences across different countries and industries.
Some people argue automation will make accounting more interesting overall. Do you agree with that, Alec?
Partially. Routine tasks disappearing is good, but constant system changes and learning curves can be mentally exhausting.
So again, the truth is largely mixed. Automation is neither pure threat nor pure blessing. It's complex and evolving.
Mia, from a tax perspective, are you seeing automation change your world too?
Yes. Software prepares returns faster, checks rules, and flags inconsistencies. But clients still need explanations and reassurance.
So you're mostly grateful for the tools, but still essential as the human bridge between law and nervous clients.
Exactly. They want someone to say, "You're compliant." And also, "I understand why this penalty feels unfair emotionally."
That emotional validation is something AI can't genuinely offer yet, even if it simulates friendly language.
So perhaps, if we become more human in our communication, we'll stay relevant even as machines handle calculations.
Nicely said. Humans need to double down on the human side. Empathy, explanation, negotiation, big picture thinking.
Listener, which skill do you want to strengthen first? Technical finance vocabulary or the ability to explain numbers clearly?
Hopefully both, but you can start with one. This podcast is largely here to help with the language part.
In our final section, we'll wrap everything together and give you some memorable lines about accounting and finance.
We'll also remind you how qualifiers like mostly, partially, largely help you sound smarter and more responsible in English. We've covered a lot today, so let's pull everything together before we say goodbye properly.
Yeah, my brain feels full, but in a good way, like after a tough workout with friends.
Let's start with the big picture. Accounting and finance quietly decide whether a company survives or slowly collapses.
At the beginning, we saw how every government demands accurate reporting, and penalties can be emotionally and financially brutal.
Then we met the basic heroes, bookkeeping and payroll, the daily systems that keep financial reality clear and salaries arriving.
Bookkeeping records everything, step by step. If it's sloppy, every report and tax return becomes partially unreliable and dangerous.
Payroll, on the other hand, touches people's lives directly. When it fails, trust and security fall very quickly.
We also talked about how accounting departments are mostly invisible when things work, painfully visible when anything goes wrong.
After that, we dove into cash flow, the real oxygen of any business, not just a boring textbook phrase.
We learned being in the red means negative balances and losses, usually accompanied by stomach knots and sleepless nights.
Being in the black means positive balances, profitability, and that rare feeling of financial relief across the whole organization.
But we didn't pretend everything is simple. A company can be profitable on paper, yet still partly strangled by weak cash flow.
We also separated insolvency and bankruptcy. Insolvency is the struggling state. Bankruptcy is the formal legal process of collapse.
And emotionally, bankruptcy isn't just numbers. It's jobs lost, dreams broken, and communities feeling mostly abandoned and confused.
Then we walked into the world of tax, compliance, penalties, and those scary letters from authorities nobody enjoys receiving.
We heard how late or inaccurate reporting can trigger audits, fines, damaged reputations, and long-term distrust from stakeholders.
Mia helped us see that tax planning is largely legal, but sometimes partially crosses an ethical line toward creative accounting.
Creative accounting sounds clever, but it can become dangerous manipulation if the goal is hiding risk rather than explaining it.
We contrasted conservative accounting, which protects trust, with aggressive accounting, which impresses short-term but may hurt later.
And we kept using qualifiers like largely, mostly, partially, arguably, to show that reality rarely fits into simple sentences.
After that, we explored automation and AI joining the accounting department, from reading invoices to predicting cash flow.
AI is mostly amazing with repetitive tasks, but partially blind to emotion, office politics, and subtle ethical questions.
Carlos explained how his job shifted from typing endlessly to checking exceptions and explaining reports more thoughtfully.
So, language and communication skills are becoming largely essential, not just nice extras, for modern accountants and finance professionals.
We used second conditionals to imagine futures. If AI handled routine work, humans could focus more on strategy.
But we also warned, if companies relied only on AI, they might completely miss human patterns and quiet red flags.
Throughout the episode, we highlighted our listening skill focus, catching those tiny qualifiers that limit or soften big statements.
Words like mostly, largely, partially, in many cases, not always, often hide very important conditions behind friendly language.
For example, our cash flow is mostly stable, means there are still partially unstable parts you should notice and question.
Or, the system is largely compliant with regulations, quietly suggests some smaller areas might still be risky or unclear.
When you listen to managers, clients, or news, train your ears to hear those qualifiers as warning bells.
They tell you, this is not perfect. There are limits, exceptions, or risks we're only half mentioning right now.
Let's recycle some key vocabulary again in real sentences you might actually use in meetings or emails.
Our bookkeeping is mostly up to date, but we're partially behind on last month's supplier invoices.
Payroll must be processed today, or staff will be understandably angry and worried about our financial stability.
We're currently in the red this quarter, but our forecast suggests we'll be back in the black soon.
The company isn't bankrupt, but it's close to insolvency if cash flow doesn't improve within several months.
We want conservative accounting that builds trust, not aggressive numbers that look impressive, but mostly hide risk.
Automation is largely helping our cash flow reports, but humans still check exceptions and anything that feels unusual.
Notice how each sentence mixes technical vocabulary with emotion words like angry, worried, trust, impressive, hide, unusual.
That combination makes your business English sound more alive and more persuasive than pure numbers alone ever could.
Now, let's give you a few lines we hope you'll remember or maybe even share with someone else.
First line, a company can survive low profits for a while, but it can't survive broken cash flow.
Second line. Numbers themselves are neutral. The story you tell with them is mostly where danger or trust begins.
Third line. Creative accounting might impress people briefly, but honest accounting protects a business deeply and sustainably.
If any of those hit you emotionally, screenshot this episode or share the line with someone who works in business.
Let's turn the spotlight gently back to you and your experience now, wherever you are listening from.
How do you personally feel about accounting and finance after this conversation? More bored, more curious, or more respectful?
Would you ever consider working in this field, or do you prefer staying slightly far away from spreadsheets?
In the comments, you could write, I mostly respect accounting because, or I'm partially scared of accounting because.
You can also practice vocabulary with a simple sentence, in my company, the biggest financial risk is, and finish it honestly.
Or, my country's tax system is largely, and then choose your adjective. Fair, confusing, annoying, efficient, unpredictable.
Remember, every comment helps you practice English and also helps other learners feel less alone in their struggles.
And yes, it also helps this channel. Likes, shares, and comments tell YouTube that this content is mostly valuable.
So, if you learned even one useful phrase today, please like this video and share it with one colleague.
And subscribe to English Podcast for listening and speaking so you don't miss future episodes on business and life.
Think of it as small, sustainable investment in your language skills, not a huge, dramatic financial decision.
Before we close, I'd love you to finish this sentence in your own mind, maybe out loud.
For my career, understanding cash flow and basic accounting is largely important because, and fill in your reason.
If you can answer that, you've already connected today's vocabulary to your real life, not just theory.
Final encouragement from me. You don't need to become an accountant, but you should become financially literate enough.
Haha, yes. Being totally blind to money is mostly dangerous, especially in a world that runs on numbers.
This is Alec, wishing you clear reports, healthy cash flow, and mostly calm year-end audits.
And this is Emily, sending you courage, curiosity, and a little extra respect for the people behind the spreadsheets.